Okay, welcome to today's lesson on Social Security. Social Security in Medicare we've talked about several times before, but it's up until now we've more associated with, well, it's coming out of my paycheck. In the beginning of the year, we talked about why there's a need for Social Security and why it comes out of your paycheck. Ultimately, you're paying into your own retirement for later in life. And so now we're going to come full circle at the end, sort of the latter part of your life, in which we're going to now use Social Security. And so there's a couple things to understand about Social Security. Just a little history lesson here, and you can read this, but it didn't always exist. It wasn't created until 1935 by FDR and the Social Security Act of 1935, in which at the time, people who were elderly didn't have any way of making income when they stopped working. So they, when the Depression happened, they lost all their money in the banks. They really struggled to pay expenses and survive. And so FDR created the act of Social Security Act of 1935 to help provide assistance for disabled or elderly people, so that when they get older, they have a government sort of guarantee that there'll be money available to them to supplement their income. Now, it is not by any means a living that they give you. They don't. You can't live off of Social Security. It's just to supplement your income. All right. So a couple things that we're going to do with Social Security. One is to talk about how you could possibly overpay for Social Security. One of the things that we've learned about Social Security, and you may not remember this, but you learned this, that Social Security is not like other taxes where there's no limit. So like if I make if I make $10,000, I'm taxed. If I make $1 million, I'm taxed on income tax. But with Social Security, there is actually a limit, and you only pay Social Security up to a certain income. Now, we're using our numbers from our textbook, which was made in 2009, so these numbers are a little bit outdated. But as far as the textbook says, the maximum income is $106,800. So what that means is that you would pay Social Security until you reach that income. Once you went over that income, you would no longer be taxed on Social Security. So normally this is not an issue. The only time it really becomes an issue is if you worked multiple jobs or you switched jobs during the year and neither job knew that you went over the maximum, and so both of them charges you Social Security not knowing that you went over the maximum. So here's an example of Jose, who worked at one job making $73,440 and at another job making $42,566. And so neither job was over the maximum, so he got charged full Social Security. So in order to figure out how much he overpaid, we have to first add the salaries up, and then that would give us the total he made that year. And you can see from the total, he is clearly over the maximum income of $106,800. So now we have to just figure out, well, how much did he overpay in Social Security? So the trick is, to figure out how much he overpaid in Social Security, you have to figure out how much he was over in terms of salary. To do that, you just simply subtract the maximum, which is $106,800, and that gives you how much he was over in terms of income. Now, don't stop there, because that's just the income he was over. To figure out the taxes he was charged going over, you have to actually multiply by the tax, which is 6.2% or 0.062. And then that gives you $570.77. That would be how much Social Security was taken out too much. So we're not gonna do the next couple questions. Basically, Social Security works by you working a minimum amount of hours or minimum wage during a year, and so the minimum is $4,360. So as long as you make more than $4,360 in a given year, and you do that for so many years, you qualify for Social Security. Now, the reason why I don't really go over this is because this is not going to affect probably any of you, if maybe a couple of you. Most of you are going to easily make over the minimum, and you'll qualify for Social Security, and it won't be an issue. So we're not going to do these questions here. The second type of question we're going to do here is example 4, and this is how you calculate what your retirement is actually going to be through Social Security. So you can technically take retirement at 62, but it's a lot less than your retirement would be if you wait to the actual age of 67. So if you want to take it out early, there's various reasons to do that. You can at 62, but if you can, you want to wait till you're 67 years old. That's when you can take full retirement. So we're going to assume you're taking out full retirement at 67. And so Marissa here averaged her income of $2,300 per month. So what that means is Social Security Administration took all of your wages from when you were 16 to when you were 67 and said, okay, we added them all up, divided how many paychecks, everything, and we found an average of $2,300. Now, obviously, that's not what you were making when you retired. It was probably much higher than that, but that's the average that you were making per month. And so to do this, there's a formula at the top, so $2,300 a month. The first one's easy because it's the same every single time, but 90% of the first $680, you just simply do 90% of 680, so 0.9 times 680. The other part's a little tricky here because the next thing is 32% of the income between 680 and 4,100. Well, we have to figure out how much is over 680. And the only way to figure out how much of your income is over 680 is to subtract 680. So by taking 2,300 and subtracting 680, we can figure out how much is over 680, which is $1,620. And so we just apply the 32% of that, so 0.32 times that, and we're done. Because we don't have, it says 15% over 4,100, but we didn't go over 4,100, so we don't need to do that. Now we just add everything up. 90% of 680 is 612. 32% of 1,620 is 518. Add them up, and you get Social Security. You'll notice that the Social Security is much less than what the average that they were making over the course of their career, and probably much less than they were making at the end of their career. It is not a lot of money. I'll tell you that wouldn't even pay my mortgage. Now, don't get me wrong, that's free money. It's money that you're going to be given by the government for the rest of your life. So, I mean, it does help, but it is extra money. But it's not something you definitely want to try and live on. So, anyways, we're not going to do example number 5. The last part here is about Medicare. Medicare is health insurance for you, and you don't have to take Medicare. You can have your own health insurance if you want. Medicare is a discounted health insurance for elderly who can't afford their own health insurance. It's not very good. Actually, it sucks. Medicare sucks. You don't want to be on Medicare if at all possible. I can explain why later, but you want to avoid Medicare if you can. Now, obviously, if it's your only option, then it's your only option. But the standard premium or monthly payment for Medicare or health insurance through the government is $96.40. And that would be for medical insurance, hospital insurance, prescription drugs, that kind of thing. That's really cheap. Somebody who is elderly and trying to get health insurance on their own would probably pay $400 or $500 a month. But this is only $96.40, so it's much cheaper. And so the questions are going to be really simple about this. So here, the monthly premium is $96.40, and Ryan paid the standard monthly premium. And so how much did he pay for the year? Pretty simple math. If he's paying $96.40 per month, how much did he pay per year or for the year? You simply just take the $96.40 and multiply it by 12, and voila, you have how much